Hey everyone, welcome back to Expound 100, the place where complex financial topics become simple and easy to understand. You've probably heard people talking about stocks, shares, or the stock market. Maybe you've seen news about prices going up and down, or heard someone say they made money from investing. But what does all of this actually mean? Let's break it down in the simplest way possible. A stock represents ownership in a company. When you buy a stock, you are buying a small piece of that business. That means you are not just a customer anymore, you become a part owner. The more shares you own, the bigger your ownership in that company. Now let's understand what a share is. A share is simply a single unit of ownership. Think of a company as a whole pizza. That pizza is divided into slices, and each slice is a share. If you own more slices, you own a bigger portion of the company. To make it even clearer, imagine a company divided into 10 shares. If you own 5 shares, you own 50% of that company. If you own 1 share, you own 10%. It's that simple. Now you might be wondering, where do people buy and sell these shares? That's where the stock exchange comes in. A stock exchange is a marketplace where buyers and sellers trade shares of companies. Some of the most well-known stock exchanges in the world include the New York Stock Exchange and the Nasdaq. Companies list their shares on these exchanges so that the public can invest in them. But why do companies even sell shares in the first place? The main reason is to raise money. Running or expanding a business requires a lot of capital. Instead of taking loans, companies often choose to sell ownership. In return, they get the funds they need to grow their business, launch new products, or expand into new markets. Let's understand how all of this works with a simple, real lifestyle example. Meet Sarah. She loves making pizza and dreams of opening her own restaurant called Sarah's Pizzeria. After doing all the calculations, she realizes she needs $100,000 to start her business, but she only has $50,000. Now Sarah has 2 main options. She can either take a loan from a bank or find investors. She decides to go with investors. To do this, Sarah divides her business into 10 equal shares. Since the total value of the business is $100,000, each share is worth $10,000. She already owns half of the business because she invested $50,000, which means she holds 5 shares. Now she needs to sell the remaining 5 shares to raise the rest of the money. This is where Alex comes in. Alex loves pizza and believes Sarah's idea has great potential. So he decides to invest and buys 1 share for $10,000. By doing this, Alex now owns 10% of Sarah's pizzeria. Soon, 4 more investors buy the remaining shares, and Sarah successfully raises the full $100,000. Fast forward 5 years, Sarah's pizzeria becomes a huge success. The business grows, opens more branches, and its total value increases to $300,000. Now here's the exciting part. Alex still owns 10% of the business. That means his share is now worth $30,000 instead of the $10,000 he originally invested. If he decides to sell his share, he makes a profit of $20,000. But remember, things don't always go this way. If Sarah's business didn't perform well and its value dropped to $80,000, Alex's share would now be worth only $8,000. That means he would lose $2,000. This is the risk that comes with investing in stocks. So the value of your investment depends on how well the company performs. If the company grows, your investment grows. If the company struggles, your investment can lose value. As businesses become bigger and more successful, they sometimes decide to list on major stock exchanges. Think of global brands like Domino's Pizza or Pizza Hut. These companies have grown massively over time, and people invest in them hoping their value will continue to rise. Now let's talk about why people invest in stocks. The main reason is to make money. Investors buy shares hoping that the company will grow and the share price will increase. Later, they can sell those shares at a higher price and earn a profit. Another way investors make money is through something called dividends. Some companies share a portion of their profits with shareholders. This means you can earn money just for holding the stock, even if you don't sell it. However, the stock market is not always predictable. Prices go up and down based on many factors, like company performance, economic conditions, and even global events. One day you might see your investment growing and the next day it might drop. That's why it's compared to a roller coaster. This doesn't mean you should avoid it. It just means you need to be smart about it. If you're new to investing, start by learning as much as you can. Don't rush into putting all your money into one company. A better strategy is to spread your investment across different companies. This helps reduce risk. Also, consider investing in businesses you understand or believe in. It's easier to make informed decisions. Another important point is patience. Investing is not a get-rich-quick scheme. Many successful investors make money by holding their investments for the long term. So to sum it up, stocks represent ownership, shares are the units, and the stock exchange is the marketplace. Companies issue stocks to raise money, and investors buy them to grow their wealth. But always remember, with the potential for profit comes the risk of loss. If you found this video helpful and want more simple explanations, make sure to like, subscribe, and support Expound 100. Thanks for watching, and I'll see you in the next video. Keep watching my channel Expound 100 for easy explanation.